Okay, you know what? I'm going to go ahead and start. And, maybe the way that we can work it is even if I can't hear you, maybe Stephen can send me questions as you have them. Or I can go pretty quickly and we can get them all answered at the end. Anyway, I'm going to get going. I'm sorry we're starting so late. A few technical difficulties there, but let's get going. So this is a pretty interesting subject, especially right now. So um, one of the things I've specialized in probably for the last at least 10 years now, I've had an options trading advisory since 1999. And I've really specialized in selling credit spreads, and you're going to see why. But the name of this webinar is Selling Credit Spreads in High Volatility Markets, 3 Keys to Turning Scary Markets into Dependable Money Machines. All right. Try and
Peter, can you hear me
advance.
now?
Okay, here we go. So my name is Peter Schultz. I'm the founder of Wealth Building Publishing. That's our big company. And then the winning secret is the strategy we're going to talk about right here. And that is selling options premium. And if you sold options premium in the past, if you've had some experience with it, that's fantastic. But hang in there with me because I think you're going to learn some things that you haven't seen or heard about before, or at least not much. So most people will tell you that selling credit spreads in volatile markets is crazy. It's not possible because credit spreads are typically thought of as a low volatility strategy, but it is possible, and in fact better than any other method of trading, I would argue, and you'll see why in this presentation. So the key is stacking the probabilities overwhelmingly in your favor. And so there's 3 big deck stackers you'll need to win consistently and generously. So as you know, if you've traded, there's no surefire lock on the markets. There's just too much variability there. But what we can do, and what's important that we do, is really stack the odds in our favor as much as we possibly can. And as you'll see, that's what we do. If you're good at that, if you're successful at that, chances are you're going to win most of the time in spite of yourself. So the key deck stacker number 1 is sell where the stock is not likely to go. Now this is really basic. If we've got a downtrending market, you're going to be selling call spreads. If we've got an uptrending market, you're going to be selling put spreads. So the object is to collect a big fat premium and then watch that premium either get severely reduced very, very quickly or go to zero at expiration. And so there's some ways that's probably fodder for another webinar, and I know Stephen's really good at this, at determining which direction the market's going to go. We use a lot of Fibonacci. I've got some proprietary indicators that I use that have been very, very effective, but I don't think you need anything too fancy to figure out which way the market's going right now, and that is down. So here's a shot of the QQQ. The QQQ is of course the ETF for the NASDAQ 100, and it gets a lot of attention because that's where all the high growth is. That's where the beta is. It moves more dramatically than the S&P 500. So that volatility is what you use with options oftentimes to make money if you're on the right side of the volatility. So we can kind of see what happened here. So here's the setup. This is actually this is a screenshot from actually our last update. So I do a weekly update, and this is it. And it kind of shows what's going on here. So when the Qs kind of bounced up here, it was a really good, all of our indicators said, man, this thing is going south. It's going down. It's got more room to go down. And so we sold a credit spread right up here. And the cool thing about it is you can get quite a ways away and still collect enough for a 25% return, which is what we target. And if you're a big-time options trader and you like to shoot for 100% and 200% and all those good things, that's great. My hat's off to you. But you might be surprised at what 25% on a fairly regular basis, if you're not losing much, can do for you. So this is actually what the note on the chart that I wrote to subscribers and kind of gave them the setup here. So the way I draw these, if you look at the chart on the far right, you'll see the bottom line here, the one that is closest to the index is what we are selling. The one that's just a little ways away from it, $2.50 away, is the one that we are buying as our hedge. If you're not familiar with credit spreads, that hedge is pretty cool because it indicates the most you can lose if the thing totally goes away from you. So in this case, it's $2.50. Then we collected 50 cents for our credit, and so you subtract that from the 250. So the most you can lose, the most you have at risk, is $2. So $2 worth of risk and collecting 50 cents, well, 50 cents goes into that 4 times, so that is a 25% gain if it is allowed to expire worthless. So this just kind of gives you, I know probably everybody here is pretty darn tuned into the market. You know, you saw everything sort of close on the lows today. On the SPX, we're sitting right on really critical horizontal support right around 4,500. We're going to see if we get a bounce tomorrow. My personal opinion, I'm just going to show you this technique that we use in these kind of markets here. So we're not going to go into, you know, quite up to the date charts after this, but I just want to mention, or kind of my theory, is that we'll probably still see a bounce into earnings as we start getting some really good earnings. Earnings have been a little disappointing up till now. But I think we'll still see a bounce, but somewhere along that first or second week in February, I think we're going to see a serious downturn. Now, I know everybody has an opinion on the markets. There are a dime a dozen. You have your own opinion. But what I back mine up with is a lot of technical analysis, and I'm seeing some weakness in some key sectors right now. The transports in particularly are a good canary in the coal mine. So I'm kind of looking for some weakness, and kind of, you know, I don't want to use the word crash too much because a lot of people do that to generate, you know, a lot of headline type stuff. But I will say this could be a larger adjustment correction than we've seen in the past. Could be, you know, fairly substantial. So let's move on and kind of see how we might want to trade that. The problem with buy-in puts is when that volatility goes through the roof, those puts get super, super expensive. And I'll show you how you can lose money on those puts even if the market goes in your favor. So that's really frustrating. So this is just an example of how this works. Instead of being afraid of volatility, it can offer some tremendous opportunity. So you watch the pattern and sell against it. This is kind of a classic rising bullish wedge. And so the minute you see that break out of there, you know, that's our signal to sell. That's when we sold. We sold a put spread just below support there, made 29% for just 9 days of time. And, you know, the neat thing about this is real cookie cutter. I give 2 trades per week, really well researched, really thought out. And we just kind of, the idea is to just repeat this over and over and over and sort of create a money machine. And then when things do go against us, and of course they will periodically, surprises happen in the market, we set stops at our sold strike, and that is sort of our fail-safe, or our you know, our safety gate to keep from losing that whole spread. And by the way, options theory tells us if we have a stop at the sold strike, we're going to lose about half of the distance between the strikes as opposed to that whole distance. So all of a sudden your downside starts getting a lot smaller, especially in comparison to your upside. So all of a sudden that risk-reward ratio starts really looking a lot better, especially when you take a look at your probability of winning. So the whole key here is the time decay curve. And I'm going to just get a little pen here. That's a highlighter. This is a pen. Let's see if I can kind of show you where we sell. So you see how this time decay curve is pretty flat when you're 4 months out. It starts to steepen up 3 months out, gets a lot steeper, and you'll notice this little bump right here gets quite a bit steeper as you're just getting ready to go from second month out to front month. Okay, so now here is the very, very, very interesting month, especially since 2012 when they instigated the weekly options. So that's a very, very serious time decay, and that's in our favor when we're sellers. When we're buyers, of course, it's working against you. If you've ever bought short-term options, either on the put or the call side, you know the time never goes by so fast as when you're it really approaches quick, that expiration date, when you buy those short-term options. So where we look for is there's a sweet spot here. You want to sell enough time to still get plenty of premium, but you really want to have that time decay curve working for you. So what we do, and these are calendar days, we sell 17, write this down if you want, 17 to 10 calendar days. And so what that turns out to is our updates come out on a Tuesday evening. We're placing those trades the next morning on Wednesday for the next Friday's expiration. So not that Friday, not 3 days away, but like 10 days away. And then sometimes if premiums aren't very high, we have to move out to 17 days. So if you have a real steady uptrend, like we used to have back in the good old days a couple of months ago on the various indices, and they're really marching higher pretty uniformly, what happens is all that volatility goes away. And that is what we're selling. That's what determines the price of our options, you know, the premium that we're getting. And so what we have to do in those circumstances is we just stretch it out to 17 days instead of 10 days. And that's how you do that. But I want to stress something, and we're going to stress it later in the webinar as well, is you don't have to hold for the whole 17 days. A lot of people think, well, God dang it, you know, I don't want to be locked in that long. I'm a short-term trader. I'm a swing trader. If the charts tell me to get out of that thing early, I don't want to be locked in there, and you are not. And we'll see how easy it is to get out. In fact, I encourage you to, especially in high volatility markets. So those are our time frames, and I've done a lot of experimentation. These seem to work out the best, where you're still getting really good premium, but you've got that time decay working for you. So that brings us to key deck stacker number 2. So this is important. Sell high volatility options to capture inflated premium that is likely to dissipate quickly. So one of the things you've noticed about the markets, and I'll just read this last little bit here. Remember, we make money by selling time that devalues as the option approaches expiration. But this strategy accelerates time decay with volatility collapse, making you money in some cases even if the underlying goes against you. So I'm going to give you an example of that here down the road just a little bit. It's actually pretty amazing how this works. So if you get into options and you start trading options, it's very, very important for you to pay attention to volatility. And most people don't. When people get into options, what they really pay attention to is which direction that stock or that underlying is going, or that index. And I will admit that's the biggest influence on an options price. But coming up a very close second is volatility, because volatility is what determines the time value of an option. And when we're selling out of the money options, all we're selling is time value. So for us sellers of out-of-the-money options, all of a sudden volatility takes this really, really, really major role. So, a lot of people say, well, wait a second, Peter, here, don't volatility markets create huge risk in selling spreads? Well, yes, they do, but if you know how options are priced, you can take advantage of that volatility premium to make even bigger profits with less risk. So if you think about it, when the volatility increases, when it gets really big, you can actually sell easily further away from the underlying and still get the same premium. So you can really distance yourself. So when you sell a credit spread, you're selling options that are entirely time value. There is no intrinsic value because the option is out of the money. So the key is how the market assigns value to the time portion of the option. That value has a lot to do with expectations. And expectations have a lot to do with what happened with the underlying in the recent past. For example, if a stock or index just made a big move or just reported earnings or just whipsawed in both directions, exactly the kind of thing that happens in volatile markets, the implied volatility goes through the roof. Now, if you don't believe that and you want to check some options chains right now, check the options chains on the put side on just about anything you want to look at. And if you want to make it easy, just go to the big indices. And you'll see that put premium is just off the charts. Why? Because the market direction, what's been going on recently. So here's an example of some volatility with Home Depot. So I'm going to get out my little marker again. You see this action right here. That action, that huge spike higher and then that sell-off down lower is what made these options so valuable. And that's what happened immediately before we sold our put spread, juiced the options premiums so that we collected 45 cents or 22% for just 3 days at a time. And we usually don't sell just 3 days at a time. I mean, that's pretty short. But this volatility is what made that possible. Now, the overall trend was to the upside, and this easily expired worthless. We ended up keeping the whole thing. But the only reason that we could do that is because of this big volatility spike right here. This is kind of an example. So to capture that inflated volatility, we're going to sell after an explosive move. The premiums are much higher than normal. This is something you can really take advantage of during earnings. Now, you know that you don't really want to take a position before earnings come out. Like I used to do that when I was a novice trader. I'd say, well, this thing's really going to move, and the last 5 times or whatever, it just really jumped higher after earnings, so I'm just going to buy some calls. Well, I got an education really quick. Like sometimes the whisper number, even though they just knocked it out of the park, the whisper number was higher than what than what the company was actually able to do, and the stock sells off after earnings. Very, very difficult to game that. But what you can do is after the earnings come out, it's like say we've got a bullish market and earnings come out and everybody's disappointed, even though they knocked it out of the park, they really did great, but it didn't hit the whisper numbers and the thing crashes. Well, you know the stock is doing good because their earnings just came out, and that sell-off is probably overdone. What it does is it just totally spikes up that put premium. So you can go way further, lower from where the stock is and still collect some really nice premium. And then chances are really good. I've noticed this 3-day cycle where something sells off, it's maybe weak for about 3 days, and then people kind of wake up and go, oh my gosh, this is a great stock. It just got super, super cheap. So, and then they start buying it. So the premiums are much higher than normal after an event like that, and they start to dissipate quickly the moment the stock starts settling down. Doesn't even have to start climbing again. If it just has a few days where that aren't outrageous, people move on to other things. All that volatility, it's like blowing up a balloon. There's all that volatility blowing up that great big balloon, and then as just 1 or 2 or 3 days goes by, it's like letting the air out of the balloon. You're letting literally the premium, the price out of that option. So here's what's interesting. Crazy wild swings don't last. They're typically followed by periods of calm. If you really want a good example of that, take a look at a chart of the VIX. You'll see it just go straight up. Oh my God, we're all going to die. And then, it comes straight back down again. But you can have periods of calm that almost last forever. Those periods of freaking out, really, really, abject fear seem to be fairly short-lived, fortunately for us. So that creates opportunity because the time value of an option can become very expensive because the stock just jumped this way or that, and often that value stays with the option even as the stock starts to calm down. It stays with it for a little while, which is why one of the best times to sell an option spread is the day after a stock announces earnings, because the options premium is often still elevated, and yet the stock is already settling down. But the real beauty of the strategy is it's so forgiving. Here's one where we did almost everything wrong and still made money. So you'll see this better on the next chart. So this is GameStop. So you remember this when it just went crazy. So it's on this chart you can just see how high it went. It was outrageous. But even down here when it was just almost nothing, and then it popped up to here, and this is the only part of the chart you could see, I said to myself, this is outrageous, just like probably everybody did. This stock doesn't deserve to be this high. Their fundamentals are terrible. They're not making any money. They're on the verge of going out of business. This is just some little anomaly here, and I can sell against this. So here's what I did. I sold, as you can see here, this right here is a call spread. Now you do that when you think the stock's going to go down. So as you can see, this was a horrible, horrible mistake. But what I did is, knowing that these spikes are short-lived, they just cannot be sustained typically, I bought quite a bit of time. And what's interesting is on this one, there was so much premium attached to these options. Even though they were deep in the money, nobody put them to me. Plus, they did some other weird things, like they halted options trading after I actually did this spread, sold the spread. So look at how wrong I was. I mean, this is terrible. So I sold up here. If this is all you could see on this chart, it would really look like a huge spike. But you can see actually what happened to GameStop. It went freaking straight up here to just this outrageous number. I think it's $483 or something like that. I mean, nobody's ever seen anything like this before. And then almost as quickly, people started taking profits. I cannot blame them. And excuse me, and the thing started coming right back down. So you can see where my where I sold out to, my deadline here, when this thing expired. And lo and behold, I mean, you can call this lucky or whatever, but it was setting the probabilities in our favor. Stop came in lower than the calls that we sold, our spread, and this thing expired worthless, and we collected 56% in 9 days. And I think that's a really, really good example of just playing the odds. You know, not knowing anything about that particular stock. I didn't know what Reddit was. I didn't know what a Reddit stock was. I didn't know what a meme stock was. You know, this is all kind of new stuff in the last year. And we've seen some outrageous things. I think we're going to see some more outrageous things. But look what happened, and we still made money. Why am I showing you this? Because this strategy is forgiving. Is it possible to lose? Yes, of course it is. It's possible to lose at anything. But the probabilities are so in your favor, this could turn into your favorite strategy. And as you can see, 56% is pretty decent. So here we are. We're going to take a look at Bollinger Bands just to get an idea of, relatively speaking, what's overbought and what's oversold. So one of the easiest ways to see variations in volatility is in the chart is with Bollinger Bands. So you guys probably know what those are. It's the standard Bollinger Bands are set up 2 standard deviations from the mean, and that's what you see with the blue line. And then the mean, the arithmetic mean, is the red line. So when those bands are wide is when the time value of the options are at an extreme high, and it's often the perfect time to sell. The reason is, as you can see from the chart, explosive moves don't last. They're almost always followed by periods of calm, and when the stock starts to settle down into a sideways move, all that volatility premium rapidly dissipates. So this is a really easy way to see this. If you guys have studied Bollinger Bands in the past, you know that when Bollinger Bands kind of narrow up, when they get a little bit narrow, that sort of precedes a big explosive move. And in this case, boom, you know, this thing just drops way down there. And so what you would do is you would sell outside the band. I rarely see a 3 standard deviation. So say you're selling down here somewhere, you can collect a lot of premium. And then, of course, it bounces back towards that mean or that rubber band, narrows up again, and we see kind of an explosive move to the upside. And this just keeps going back and forth like this. And so it gives us a really good timing indicator of when to sell premium, and perhaps if you're an option buyer, when to buy premium. So wouldn't it be nice to see at a glance whether options premiums are expensive or cheap? You know, everybody says this. You know, they used to say it to me. They'd say, well, sell your options when they're expensive, when the volatility is high. And I'd say, well, that's great. How do I do that? Well, fortunately, there's a way. So many options trading programs and brokers now show statistics for historic versus implied volatility. So historic volatility is what the range of movement has been over a long period of time or a longer period of time. And implied volatility is what the volatility is doing right now. Like, what did it do in the last 2-3 days? You know, what's happening right now? So how can we kind of see that at a glance? Well, the key when selling options is to take advantage of inflated pricing, is to sell when the implied volatility obviously is higher than the historic volatility. That tells us at a glance that the time value of the options is high and that it has a good chance of settling lower in the immediate future. So where the heck do we find that information? So we generally, for options, I still think this is the best platform. I know people use a lot of different platforms out there, but if you look at YouTube and options trading videos, boy, almost everybody's using Thinkorswim. So even now, even today. So we generally recommend the Thinkorswim platform for options because they have really great trading tools, especially once you get to know how to use them. And you have the ability to get filled inside the spread, which is really, really important. That saves you a lot of money. And they're competitive on their fees. So any good options trading platform should be able to provide this information, but on the Thinkorswim platform, you go to the trade tab and enter whatever underlying you're interested in, you know, and then the whole options chain populates, either a stock or an index. And at that point, all the different expiration dates will populate underneath your ticker. So let's see where we can find this information. So you scroll to the bottom of all the dates and you'll see a drop-down arrow that says today's options statistics. So click that drop-down arrow and you'll see all kinds of options numbers. But what you're really looking for is the current historic volatility, the HV, percentage versus the implied volatility. And I've got them circled here. This is what they look like. So if implied volatility is higher than current HV percentile, then the option is expensive. That's the easiest, quickest way to see it. So you see that they're right down here with these. You see these two red ovals here. Current HV percentile is 19%. Implied volatility is 30%. This is an expensive option. So this is one you should consider selling. Now, obviously, you're going to look at the chart, and the whole idea is this is like a game of tag. You want to sell an option that isn't going to get touched by the underlying. So, you figure out, kind of take a look at your chart with all your charting abilities, and you say, where the heck is this stock probably going to go? And a lot of the time, unless there's a really big market change, it goes in its current overall trend. But this just gives you a really quick way, a quick and easy way to see what's expensive and what's cheap. Okay. So once again, we just talked about this. If implied volatility is higher than current HV percentile, then the option is expensive. And of course, the reverse is true as well. So here's what's interesting about the time value of an option. Everyone thinks the value is based on the time remaining until expiration, right? Does it have 10 days remaining? Does it have a month? But here's what it's really based on. What is that time worth? So it's really based on the implied volatility of the underlying. So this is an example that's kind of going to blow your mind. I mean, we talked about this a little while ago, and it's going to kind of blow your mind a little. Blew my mind. So here's a great example. So Walmart announces earnings, and the stock explodes and reverses, massively spiking the volatility premium on the put side. So it went up here, and then see what happened is immediately got sold off. I mean, pretty severely. And so it really spiked the premium. And so when it did that, when this happened, when it really started coming down here, we sold the 120 put spread, right? So here's what's interesting. So it came down. Apparently it came down for a reason. People were disappointed. And then it proceeded to keep going down. At one point, we had a pretty severe spike lower, and then it popped back up again. But here it is. Here you've sold this option, so now you're biting your fingernails off because the underlying is kind of coming for your option, right? It's getting closer and closer and closer. And here it is. It's coming down this way. And so you would think, as the underlying is approaching your strike price, that the option on your strike price, this 120 put, is going to just keep getting more and more and more expensive, right? Until maybe it touches, and then you have to close your trade and you lose money, and that would be terrible, right? Well, here's what's fascinating about this trade. So when this happened, when this spike happened right here, the time value of the 120 put spiked massively, and we collected, just like a ton of money, even this far out. So we're selling all the way out here with all this time, but we still collected a really, really substantial premium. So here's what actually happened. The time value of the 120 puts dropped dramatically after the announcement. Why? Because this little pattern here is much easier and much less dramatic than this pattern. So when this first pattern happened, this option got really, really expensive. And then that air started getting let out of the volatility balloon, even though the stock continued towards that put strike. So it continued trending lower, and then and here, this bottom chart right here, what you're seeing right here is the value, the actual value of the options themselves. So here's where we sold on the volatility spike. You can see up here where it says volatility spike. Well, here's where we sold right here time-wise. And look, and here's the actual value of the options. So it's way over here. So we collected this huge amount of money. And here's the crazy, crazy thing. And this is not an isolated case. This is how options work. So even though the underlying is going towards your sold strike, here the value of it. See how all this air got let out of this option just right here in the very beginning? It lost so much value as soon as that thing started to level out. And then it continuously lost value until finally the darn thing expired worthless. So here's a bigger chart. What's amazing is the option declined in price in spite of trading toward the strike. That's crazy. That goes against everything most people have been taught about options, mostly because of volatility collapse. And then also, we can't forget time decay, which in this case trumps direction. So this is an example of direction was against us, and because of time decay and volatility collapse, we still ended up making money on this trade. Really, really good money. So, I mean, that's the most dramatic example I can show you of how effective volatility is. And listen, let's flip this around to the other side. So if you're scratching your head right now and you're going, you know, that could explain why I bought calls or I bought puts that one time that stock really spiked and the thing kept going in my direction and I ended up losing on the trade. That gets so frustrating. And it makes a lot of people quit trading options right there. They go, this whole thing is stacked against me. Even though I was right on direction, I did all my research, I took my chance, I took a big bet on this thing, and I bet on it, and I still lost money, even though it went in my direction. You know, this sucks. You know, I hate this. I don't like this. So I got to tell you, that was me for a long time. That was me. I was trying to make options work, and I kept buying them, and I kept losing money, and I couldn't figure out why. And then one day I just scratched my head, and I just took a look at some of this stuff, and I go, man, you know, the value of these options really dramatically changes based on what just happened. And even though you can bet in the right direction, you can still lose money. And that's one of the things that pushed me over to the option selling camp. And I got to tell you, I never left for one simple reason. I got used to winning. You know, I was early in my career, I was on a plane. I was coming home one dark and stormy night, and I sat next to some old wizened stockbroker. You know, this guy was retired and he was about on his second whiskey, you know, and he goes, I was young at the time, this is years ago, and he leans over finally after, you know, halfway into his second whiskey, and he growls at me, he goes, son, you can either be a collector or a contributor in the stock market. Which one do you want to be? You know, I kind of took that to heart, and ever since I started selling options, I've been a collector. Collect. You get the money right up front, and then we'll see if the market can take it away from you. But as you can see, with volatility collapse and a lot of other things going out there, if you kind of know what you're doing, well, it's hard to get that money away from you. You just end up keeping it most of the time. You know, they have to worry about time decay. They have to worry about volatility collapse. You know, you just keep stacking these really powerful tools in your favor. So now this makes the next key possible. This volatility collapse makes the next key possible. So key deck stacker number 3. Make your money and get out once you've realized most of your gains so you limit your risk. And here's why. So volatility collapse lets you do that because it accelerates time decay, right? So if, like, say there's 10 days left of time and the time value, just to pick out a number, is worth $100. So that's $10 a day. But all of a sudden on day 2 that you're in this trade, or day 3, there's a bunch of volatility collapse. And now all of a sudden, the 8 days that are left are only worth, you know, say like $20. Well, each value of a day just went down dramatically because those days are priced based on volatility. So here's what's cool about that is when that volatility collapse happens, and it maybe only takes 2 or 3 days, get the heck out. I mean, keep in mind, now, if this was a continuously trending market, like jumping on the escalator, like we had so much of last year, you know, after the big V bottom back in March, you know, or back in actually March of 2020, and the market just started climbing and climbing and climbing. It's literally like hopping on the escalator. There's no reason to get out early because you just hang out there, and you know these things expire worthless, and you keep all the money. Easy, 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 easy. And fortunately, the market is trending most of the time. Where it gets dicey, where it gets weird, is times like right now. So the market spikes up one day, it spikes down one day. It spikes up another day, it spikes down. Can't make up its mind. That's often topping action. When you see that, what we've witnessed really since November is topping action. Takes a while to turn a great big charging bull like we've had. You see that topping action, and then all of a sudden, you know, the last couple of weeks here, it's just been kind of down, 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 and all of a sudden the market's made up its mind. And we are, I mean, I don't know what definition you want to put on it, you know, 10% down, 20% down, whatever, but we really are in a correction right now, and that's very likely to turn into a bear market. And bear markets are a little bit trickier to trade than bull markets. They're not quite as uniform. But you do have a lot of opportunity. You have more volatility spikes. But when in a market like this, when it gets a little crazy, and how you can tell is if you're just a little nervous. If you're just a little nervous putting on your credit spreads and you just don't quite know what the direction's going to be, if you're a little bit nervous, do this. Be the monopoly guy that takes the money and runs. You might only be in a trade for 2 or 3 days. You might sell 10 days at a time. You might sell 17 days at a time. But get the heck out. You know, the building's on fire. Do not wait for an engraved, monogrammed invitation. You don't just go, boy, there's a sack of money sitting there. Grab it and run. And that means close the trade. So the good news, if you sell right, you can get out early without leaving much on the table. So here's a good example. So, Visa's been a pretty good stock. We sold the spread for 45 cents and bought back 9 days later for 5 cents. So we kept 90% of the profit for a 20% return. Why would you stay in this trade for 5 cents? Why would you have all that risk? Why, this is probably a 17-day trade, and we got out 9 days later. So we're only in this thing about half the time that we were going to be in it, but we collected 90% of our profits. A good way to look at that is, would you sell that spread for 5 cents? Heck no, nobody would. It's not a good enough return. So it's a great time. If you can answer that question, no, that's not enough money, it's a great time to get out early. Just grab the money and run. So as you can see, getting out early can be a smart strategy. Look what happened if we would have stayed in. Look at that. Some little piece of news came out, the thing fell out of bed, and isn't this so typical for all you guys that have traded, gals that have traded? Here's our uptrend, right? It's just so steady. It's just so perfect. Anybody could make money on this, right? Right until you get in. Then when you get in, the thing falls out of bed, stops you out of your play. You lose a bunch of money unless you just got out. You just took the money and ran. Smart thing to do. If you even get a hint of volatility, if you even get nervous, or if you've already realized 80 or 90% of your gains, just get out. Now, some of my guys, some of my traders have been with me a long time. You know what? They really don't like losing money. So they get out as soon as they've realized 50% of the premium that they collected. That's going to happen, even just on an intraday spike, And fortunately with Thinkorswim, we can set these automatic orders that exit us out. We don't even have to watch it. I call them money traps. You don't even know what happened, and then you log into your account and you say, oh, I'm already out of that spread. Captured a nice profit. So just because you sold 10 days doesn't mean you have to stay in for 10 days. So we sold the spread for 95 cents and bought back 4 days later for 15 cents, keeping 84% of the profit. And what we actually ended up making on this deal was 20% profit in just 4 days. Keep doing this. You keep linking these together and you keep doing it on a regular basis. You're going to get rich doing this. Because if you do it right, you don't lose very often. And you just make money over and over and over and over. So the point is, once you've realized most of your profits, take them. And that's especially true in volatile markets. So the moment you close the spread, you eliminate risk, you keep the profits, and you free up your margin. Pretty sweet. So the 3 keys for selling credit spreads, if you're the type to take notes, this is a good time to take notes. So number 1, sell where the stock isn't likely to go. Sounds pretty obvious, but that's important. So it's like a game of tag. You want to have fun out there on the lawn, but you don't want to get tagged. So number 2, sell short time frame, high volatility options to take advantage of volatility collapse. Sell when these things are overpriced, buy them back when they're underpriced. Number 3, once you've realized most of your profits, exit the trade and lock in your gains. Go out to dinner. If you really made a lot of money, have the $1.99 special at Denny's for breakfast. Or I don't think it's $1.09. It's probably $5.99 now. Supply chain constraints. So follow all 3 and you stack the probabilities overwhelmingly on your side. So you don't even have to be able to say that word to make money doing this. So pretty cool. You know what's so fun about trading, and I hope you found your niche, but I've tried a lot of things, right? I bought options. Everybody's, like, you see these come-ons and stuff, and people, oh, we made 200% on this and 300% on this. And you try and replicate that and you just can't seem to do it. It's like beating your head on the wall. I don't know an options trader that hasn't blown up their account 2 or 3 times. And if you're not familiar with that term, that's kind of like your account gets vaporized and, it's kind of like, okay, you got to save up your nickels and dimes before you can play again. And I just got tired of that. I did it for years. Any sane person would have quit. Finally, I mean, it's like this big light bulb goes on over my head, and it just said, become a seller instead of a buyer. And all of a sudden, all the really scary things about options turn into your best friends. And so this has turned into my little niche. And for years and years and years, I've just been making money pretty regularly just selling options. And there's times when you don't want to play. If things really get weird and you really can't figure out which way things are going to go, just step onto the sidelines. But there's almost always something you can collect. And I'll tell you something I'm looking at right now that I'm so excited about, I can't hardly stand it. I'm just going to tell you real quick. And this is kind of a personal thing, but Tesla makes some really exciting cars. Everybody's all head over heels in love with them. But is the company really worth $1 trillion? So $1 trillion is $1,000 share price, right? Because they have a billion shares out there. So if it's not really worth $1 trillion, is it worth $1.5 trillion? Or is it worth $2 trillion? So here's what I want you to do, all you option heads out there. So I want you to go to the Tesla options chain. Go out a year. Go to January 2023, and you click on even the $2,000 strike price, and it's some outrageous amount of money. Now, if you have, I'm just going to pick something here. It fluctuates every single day, but let's just say it's $100. So that's $100 per share times 100 shares. I think it's $1,000 or it's $10,000 anyway. You sell these things naked, and you can bring in such a mind-boggling amount of money. And do you really think that a year from now, when everybody else is selling electric cars, Ford's coming out with the F-150 Lightning this summer, Rivian's already out, Chevy's coming out with an outrageous pickup truck that's electric that has four-wheel steering. I've got money down on every single one of them. Whoever gives me a truck first, And in my part of the world, I mean, pickup truck out, right? So meanwhile, the Cybertruck, who knows when that's going to come out. So you can collect a ridiculous amount of money for a $2,000 strike price a year from now. I'm not talking about a spread. I'm talking about selling naked. Now, obviously, you have to be able to sell naked, and you have to, have the margin in your account. But I mean, to me, this is, and I do this once in a while on my own account as I sell something. I sold Sava a little while ago because Sava Biosciences, I think they're a big fraud, and I sold like the $200 strike when the stock was something like $90. Collected $27 naked, and did 10 contracts, and $27,000 just showed up in my account in about 10 seconds. I go, that felt kind of good, and then I did it again, so I collected $54,000. And people have the audacity to say that selling options is boring, or selling options you don't make the big money like you do with buying options. Frankly, I think it's just the opposite. So look, I'm going to stop ranting right here. I know we have a limited amount of time. I'm going to get to my little offer here. So if you follow this strategy, what can you expect to make? Now, this is not selling naked. That's not what we're talking about. I just told you about that on the side. Pretty cool thing. But the beauty of the strategy is consistent gains that compound quickly. And so this is all spreads. We're going to be buying that hedge. So we target 25% per trade. So what's an attainable return that you can expect over time? So we're targeting 25%. So there's cash holdbacks, there's losses, there's going to be losses, there's buybacks, sometimes you roll a position. So instead of making 25%, can we make 20%? Can we make 15%? Maybe. How about 10%? And keep in mind, we're selling these every 10 to 17 days, so figure about 2 weeks. So, you're turning your money. You're turning it every week because you're staggered in these things. But let's just say you're turning your money twice a month. So let's lower that to just 5%. So this is an amount I know anyone can make. We've averaged since inception more than that. But the key is you're turning your money every 2 weeks. So let's see what that looks like, starting with just a $10,000 account. Now, this is just fun stuff. I realize things don't go up this uniformly. It's the real world. You have your ups and downs. But let's just take a look at this chart because this will kind of maybe inspire you a little bit. So take a look at this. This is 5% compounded every 2 weeks for 2 years. So if you start off with a $10,000 account, what does the money grow to at just 5% every 2 weeks? So after 2 years, 10,000 has grown to 104,000, and you're bringing in over $10,000 per month. And even in these inflated times, you can still make it on $10,000 per month if you keep your trips to Starbucks to a minimum. So I think that's pretty cool. Now the real world, in this, if we just get our little cursor here, it's going to be jagged. It's going to be going up and down. You're going to have times where it's easy and times when it's hard. But basically, it just sort of accumulates, and that's what happens. Why? Because the probabilities are on your side. So you can try this strategy out for yourself. I encourage you to do it. And starting with as little as $200 per trade, you don't have to risk a lot of money. There's just one problem. If you don't do well right off the bat, you might disregard the whole thing and quit, especially in a market like this one. And that would be a shame, because this really is the best way to trade because of your very high likelihood of winning, the hands-free nature of the trading, and the tremendous compounded returns over time. And compounded returns is just making money on your money. So to make sure you start off profitably and stay that way, I put together an educational package that is the best anywhere for this strategy at a fraction of the $2,500 sales price we used to charge. And I really did charge that, and people are still thanking me because, boy, they made that back plus a bunch. So it's called The Winning Secret, and it includes a lot of things. It's first thing you get is how to trade credit spreads for fun and profit. It shows you step-by-step how credit spreads work, why they work so well, and how they can work for you. This is kind of your intro. Plus, you get a 161-page downloadable ebook complete with color charts, graphs, pictures, and everything you need to start trading profitably and stay that way. Plus a 10-chapter video series I just finished a little while ago. It's replaced our old video series. This is exciting, moves along quickly, gets the points across really well. I think you'll like it. You can hear and see exactly what to do to start generating this income. You'll also gain access to your archived webinars and video tutorials so you can discover new strategies and ways to improve your returns and limit your risk. And you'll have access to all new additions for life as an owner of this package. So this is a one-time charge, just one time. It's not any recurring thing. And you buy it one time, you have access for life, and no matter how many improvements we make or how many additions we make, you're still going to have access to this package because you just log right into the website. It's all right there. You can get into it on your mobile phone. It's great. Plus, you get videos that show you how to set up automatic orders with our favorite broker, and that's Thinkorswim, for spread trading to trap profits, whether you have time to watch the markets or not. That's what I love, is not having to watch my trades. Not having to watch. Like all those guys that buy back when they've reached a certain amount of profit, you can do that. You can set that all up automatically, and I show you how to do that. Okay, now this package that we're offering here tonight has two components. Number one is the educational part. So that's that. You get that for life. The other part is a subscription if you want to trade along with me, and I can kind of hold your hand and show you what to do. So with the subscription, you get 2 high probability trades every week. And I'll show you exactly where to sell your spreads and exactly how to sell them with the possibility of maximum gains with minimum risk. Plus an extra bonus, you'll get a 10-module video course specifically on trading the weeklies. And in addition, here's where we're really, really different than everybody else out there. So the best way to learn is through one-on-one instruction. I have an incredible staff. They're fantastic. They're all ladies. They're all smarter than I am and vastly better looking. And that's the way it should be. So included in this package is a free one-on-one orientation, and who's doing this now, you can kind of see her here, is Deanna. And she's going to make sure you get your account set up the right way. If you don't have the right trading clearances at Thinkorswim, she'll tell you how to navigate that. She'll tell you how to get around the website. She'll show you what to look for, how to get the most out of your service. And this is one-on-one. This isn't a group deal. This isn't some group, webinar or whatever. She's right with you and shows you exactly what to do and takes you around one-on-one. So that's fantastic. I don't know anybody else that does that. And then this is killer. So this is Alicia. The gal's not just good looking, but she's absolutely brilliant. She graduated in finance at her local university here. She loves numbers. You're going to get a personal one-on-one real-time coaching session, 45 minutes. It's going to be tailor-made to your learning pace, your skill level. And this session is designed to increase your knowledge, confidence, and profitability. And I want to really emphasize that last one, profitability. So what people, this is going to be an intro session. I think you're going to want more. And so what we do is we sell 3 and 8 session coaching packages with Alicia. It's not so you can learn what a put and call is. You know, maybe that's what it is in the beginning, but what she does is she actually finds trades out there and helps you make some really great profitable trades. So we've got a bunch of people that just do 8 session back-to-back sessions one after another because they get together, they have fun. Alicia's fantastic. You're going to love her. She's the one that I bounce ideas off of. She's in the next office over from me. She's great, really, really smart. She makes people a lot of money. So Alicia's great. Once again, you're going to get your first session with her. You can decide for yourself. I think you're going to like her. So this is all putting it all together. I want you to come on board so we can trade this plan together, invest what you can, and prove to yourself how well this works, and then watch your account build. So to get everything we've talked about, go to fearlesstrades.com, and I'll look forward to seeing you inside the site. If you want to call us during office hours, there's our 1-800 number. And this kind of shows you everything you get. So you get time with Alicia, you get time with Deanna for your orientation, and this is the subscription service up here. That's me holding out a big old tablet with our update on it. And then this down here is the whole educational package. So I've probably gone over my time. My apologies, but I can sure answer some questions. And Steve, I don't know if you want to type them in or they can be in the general questions, whatever way you want to do it. And I wish I could hear you guys, and I can't, and I'm sorry about that. Technical difficulties
Can you hear me?
and all that good stuff.
Okay.
Let's see. I see. Stephen has messages for me. He says, my cursor does not perform on the slides. Oh my gosh. I've been doing all that drawing, and you guys haven't been able to see anything. I'm sorry about that. Okay. Questions, anybody? I got the general chat here. Oh, how much? How much? Yeah, thank you. So the subscription service is $99 a month, and that repeats every month, and you can knock that down pretty good if you do a quarterly or an annual subscription, which I encourage you to do it monthly to see how you like it, and then if you like it, you can get yourself a big discount. And then the actual educational package, which you have access to for life, is $395 all by itself. So you combine that, you're right around $500, and this whole package for the webinar for Steve's people is $397 for the whole kit and caboodle. Okay. So my speaker is working. The microphone's working. How wide are your spreads typically? And here, Kevin, so that's a question by Kevin, and our spreads are typically the narrowest they can be and still get a decent credit. So if we have access to $2.50 wide spreads, we do those. Something like the S&P 500, we're going to do $5 spreads. And if a stock has $1 strike prices, we do $2 spreads. That seems to be the sweet spot. So kind of the narrower the spread, the more actual percentage return you get, which is actually really cool. Oh, Jim says he saw the artwork. That's reassuring. Thank you. Appreciate that, Jim. That's $2 lower than what the website says. Oh, wow. I shouldn't be on the website. So this is a webinar special. Why did you sell the put spread when the stock was to go down instead of the call spread at the peak? So that's a good question. And the reason for that is I usually trade in the overall direction of the stock, because that's usually what reasserts itself, and also if that's confirmed by the overall direction of the market. So obviously right now I'd be selling a lot of call spreads. What's your win rate? We're right around what the statistics would indicate based on what we sell, and it's about 80%. Compliments to your art department. Your slides are impressive. Thank you, W2JC. That's one of the sweetest things anybody's ever said to me. I appreciate that. Anybody else? Ask whatever you want. I can actually see your questions, which is good. Going once, going twice. Go to fearlesstrades.com. I think you're going to like this method of trading. Are you selling Delta 20? So John C. says you're selling Delta 20. John C. knows something about options. He knows that if I have an 80% chance of winning, or better, I'm selling 20 or lower. And John, that's exactly correct. How long is the special good for? I'm going to make this good for the next 2 days. I want you to come on. There's a lot going on in the markets right now. I've also got some other services. I have a microcap investor that's been incredible. Made a few people millionaires with that, including myself. And that truly is passive. So that's something you want to check out too. It's called Microcap Investor. And you can go to our website for that. But this is a really good method. If you like to trade, it's a really good method of winning most of the time. Will that phone number get a person? Yes, it will. You're going to talk to Heidi Florentin, another really, really smart gal, and she's great. And you'll like Heidi. It's wonderful. Might even get Alicia. We'll see. Yes, should get a person if you're calling during office hours. What percent of your strategies are credit spreads? What are the other strategies? Okay, so that's a good question. And what I used to do for my trading, now the investing in the microcaps, that's different. You know, that's passive. We get into something and we watch it grow over time. But for trading, 100% used to be credit spreads. And then when I introduced, you know, when you have a big trending market like we've had for the last couple of years, actually the last, since about 2009 or 10, we've had a trending market. So when that happens, there's another strategy that I use called the greatest option strategy on earth. And that's what got me retired originally back in the 90s. And what that involves, some of you call that calendar spreads, some of you call that diagonals. What I do is I take something that's trending and has a lot of reasons to continue trending, both fundamental and on the chart, and I'll buy a long-term option. So that long-term option in a really choppy volatile market like this one might be only a month or a month and a half. And if we have a really good long trending market, I might buy 6 months. And then whenever that thing peaks, when it gets to the top of its Bollinger Band and it gets really, really overbought, we'll sell against it. So if you buy a really long call, we'll sell calls against it, knock down our cost basis, get some great income, and then have hopefully a big pot of gold waiting for us at the end of the rainbow. And when you use Bollinger Band to sell call option, yes, you can. You can do that. Yes, that's one of the indicators. Minimum credit you're willing to collect on a $5 spread. So that's what Mike asks. And if we are targeting a 25% return, the minimum credit we would be willing to accept on a $5 spread is $1. Sometimes we go down, depending on the market, down to 85 cents. But basically it's $1. So sometimes we'll get 20%, 22%, 23%, but we're kind of targeting 25. In the money credit spreads are well worth learning about. Thanks, Peter. Great. So this is a fun subject. I wish we could hear each other because I'd actually really like to just talk to you guys. That would be a lot of fun. But options are cool. There's so many things that you can do with them, and it's one of those deals where the more you learn, the more you can kind of tweak things, and I like the volatility, kind of put it in your favor. So thank you. I don't know how to say this. Etienne, thank you very much for coming and listening, and I appreciate your thank you. So thanks a lot. Oh, that's good to know. I'm correct. So thank you, Stephen, and thank you, Becky. And once again, I'm very, very sorry for the delay. I really appreciate you guys waiting, and it's been great to kind of share some information with you. Trading's kind of fun. It's like chess or golf. You can practice it for the rest of your life and never perfect it. And I think that's one of the things that makes it fun. And you can also collect a little money along the way. So that's good. Thank you, Stephen. Appreciate it.